Hey traders, Jason here from Leavitt Brothers. In this video, I'm going to cover various breadth indicators. Okay, when I analyze the market, I look at the index charts on various time frames. It's not that hard. I just want to see if the charts are trending up or trending down or moving in a non-directional range. Then I look beneath the surface at the market's breadth. Doing this entails counting the number of stocks within a group or index that meet certain criteria. Okay, for example, the main breadth indicators that I look at are, just very simply, the advanced decline line, percentage of stocks above various moving averages, and percentage of stocks at various high lows. Okay, so for example, and you guys know this is a little quick review. If the S&P 500 does this, okay, the number of stocks trading above their 50-day moving average might look like this, and it might be like 400. Okay, and if the S&P rolls over and then moves up to a higher high, the number of stocks above their 50-day moving average will, it could come in like this and roll over and be at 350. So that would imply that 50 less stocks participated in this move. Okay, or it could come up and match the number or get pretty close, and therefore essentially telling us that, hey, same number of stocks approximately participated, so the uptrend is confirmed. And so I do this for various moving averages, stocks above their 20, stocks above their 50. I also look at it for various high lows. Okay, market moves up, a certain number of stocks will make a 1-month high versus a 1-month low, or a 3-month high or a 6-month high, and then the market could rotate down and come back up. And same thing, I want to know, is participation the same or is participation falling off? Works in the opposite direction too. Market falls off, comes back up, makes a lower low, but maybe the number of stocks making a 1-month higher low does something like this, where it's like, hey, suddenly, that number right there, maybe it doesn't tell you that stocks are making a 1-month high, but it tells you that less stocks are making a 1-month low. So that tells you that some strength is starting to come in. Even though the market moved down to a lower low, less stocks move down to a lower low. Okay, so breadth just gives you a way of, instead of applying a certain criteria to the overall market, you're going to apply it to a group of stocks and essentially ask how many stocks within this group meet the criteria. All right, so let's go through these various indicators, and we'll see, we'll get a kind of a state of what's going on right now. All right, so here's the S&P 500 versus the advanced decline line. This is a cumulative advanced decline line, and I put a 50-day moving average on there, which isn't a magic line, but it tends to be a pretty good, gauge. Okay, market trends up, as you can see here, and the advanced decline line also trends up. Doesn't just trend up indefinitely. There are some, pauses and dips, but generally speaking, it trends up above its 50-day moving average. Okay. So what I want to do is see is are advancers beating decliners on a consistent enough basis to suggest that that an uptrend is supported. So since the March low, the line's been generally moving up. We had a pause here, okay, and then we had a little breakout. We had a pause here, and then a breakout, and then a continuation. And now we're getting another pause here, except this one for the first time. It's it's dropped below its 50, which isn't a magic line in the sand. It doesn't mean the market's going to collapse. It's a reference point. It tells you that this drop here is worse than the last two pause periods. This was a little bit of a drop. This is more of a pause. So something to keep an eye out. Okay, the advanced line, we actually had. Let me erase some of these lines. So we actually had a divergence here where this trended. We made a lower high, and up here we made a higher low. So that was a little bit of a warning heading into this month. Now the market's gone down. We've put in a lower low, a lower high, and now another lower low. Okay, it's salvageable. The market doesn't have to collapse here, but it does kind of get our attention. Okay, if the market continues down or goes sideways here, and this continues down, then the 50 could become resistance on the way up. Okay, we can have a bounce and a rejection and something like that. Okay, the further below this goes, the more trouble the market's likely to be in. So I would consider this situation right here to be somewhat fragile, somewhat sensitive. It's salvageable, but it could also just break down from here. All right, here is the Russell 1000 stocks above their 20-day moving average. I use various indexes. I like the Russell 1000 because there's only one stock in the Russell 1000 that's not $1 billion. So the Russell 1000 contains every single $1 billion company that trades in the U.S. Okay, so it is the market, and I like the fact that it's just every $1 billion company as opposed to the S&P 500, which is those are hand-selected companies. Okay, for example, Tesla's not in the S&P 500 for some reason, yet there's a lot of oil companies in there that I don't know why they're in there. Okay, so this is the number of stocks. The blue line here is the S&P 500, and then all this black. The black stuff is the number of Russell 1000 stocks above their 20-day moving average. Okay, so when the market is trending up and is supported, you get pretty good prints, oftentimes upwards of up to like 80%. There are dips to low numbers and then quick recoveries, and as long as you get a quick recovery back up to like the 80% level, the market tends to be just fine, okay? The market moves up and moves sideways and moves up, and during that sideways period, a lot of stocks will lose their 20, but as long as that quickly recovers, the market's in good shape. Over here, we got a low print and a quick recovery, but there was a space here where not enough stocks got above their 20. So that was a little bit of a warning going into the February high. Come look over on the right side of the chart, dip here, but an immediate recovery, and obviously we had a really high print and high prints there. We had a dip here, but another high print over 80, dip here, another high print over here. So it's okay to get dips as long as you get a good recovery. So if I look at what's going on right now, we have really low prints here, which are as low as they've been since since late March, early April. So if the market bounces here, the no guarantees, we're going to want to see this not only get up to here, but to confirm strength, we're going to need prints up at like 80%. Okay, simple as that. Okay, a little bit of if we get like tick marks over here and it kind of bounces around over here or something like this, that's going to be a warning. Okay, any type of bounce here, we're going to need to see rapid expansion of this indicator up well over 60%, close to 80%, preferably over 80% to confirm that an uptrend's in place. If we don't get that, the market's going to roll back over. Okay, this chart similar. Okay, but instead of above their 20, it's above their 50. Okay, and as you can see, as the market trends up here, the number of stocks are comfortably between 60 and 80%. You get some prints up here at 80%. Little bit of a pullback here in the market, and suddenly the number of stocks above their 50 went from 80% down to like the low to mid 40%. So that was a little bit of a warning that the market didn't have to move down much in order for that many stocks to lose their 50. Then on the recovery, the market recovered, went to an all-time high over here. Yet look at this. Okay. Look at that. Like at most we have, this is probably like in the high 60% range. So not only we didn't get above, up to 80, we didn't even get up to 70. So there's this big void space, which told you that. Let me get rid of these and re-put them on. So which it told us that market moved up, corrected, and then moved up to a higher high, and yet the number of stocks above their 50, there was a lot less stocks participating. Instead of like 80%, this is more like 68%. So 12% of the Russell 1000 is 120 less stocks moved above this moving average. So that was a warning. So we come over here to the right side of the chart, and the situation is very similar to the 20-day moving average. We have really low prints here, the lowest prints since way back over here. So if the market tries to curl up here, we're going to need to see rapid improvement, up into the high, at least above 70. Preferably up to 80 to confirm that the uptrend is back in place. If we get a measly rally here and it struggles, and we get like this type of action for a week or two where not many stocks are able to get above their 50 at the same time the market's pressing higher, that's going to be a warning. Okay, you can see here we have trend line break here, moved down, recovered above 60, but then fell. We have trend line break over here, moved down, couldn't even recover, and is now at a lower low. Okay, this is the lowest print since way back here in April. So we need rapid improvement here. This situation I consider to be very sensitive, and it could break down at any time. All right, here is the Russell 1. This is the SP 500 versus the 1 month 1 month high low of the Russell 1000. So it's number of Russell 1000 stocks making a 1 month high versus them making a 1 month low. Okay, when the market trends up, you get steady prints. Let me put a frame on that. It's easier. Okay, you get steady prints above zero for this index because of 1,000 stocks. You get steady prints between 0 and 200. That's pretty normal. And you do get these random prints above 200. Okay, and those are needed. You need random prints up high just to tell you that, like, hey, the market's alive, it's healthy, it's doing well, and yeah, you're going to get these little spurts up. You notice what happened here is that the market went up, came down, and then went up again, but the number of stocks at a 1 month high or low never could print a high number. Okay, even though the market was doing really well, the number of stocks didn't follow along. So you had a low print of recovery, but you didn't have like a random print up here. So move over to the right side of the chart. You got steady prints in here, and then you got these random high prints scattered along here, which tell you, like, the animal spirits of the market is alive and well. You got low print here during the correction, but then it recovered, and we get some higher prints up in here. But then again, what you have here is, like, the market moves up, but from about like right about there, you only have a single print up here. So this entire time that the market did this, only one on a single day was the high, or Russell 1000 high low, able to print this. So that was a little bit of a warning. So now we had a really low print yesterday, and right now we're sitting at negative 92. Okay, if the market bounces, we're going to need prints up here, for a week, 2 weeks. Give us some indication that the market's more stocks are at a 1 month high than a 1 month low. And then to really confirm an uptrend, to actually have the market go up to a new high, we're going to need to see some random prints up here. Okay, just some random prints above 200 to let us know the market is alive and well. But when you look at what's going on down here, where we lower high, lower low, lower high, lower low, lower high, that doesn't look that great. We're at the lowest level. We're below this. So we need a recovery here. Okay, we need a recovery here. All right, one more chart. This is the same concept, except instead of the 1 month high low, we have a 3 month high low. Similar idea here. We get a lot of prints between 0 and 200. We get a random scattering high prints here. Okay, no high prints over here. A little bit of a warning. Not too much though. I mean, this has actually been pretty good shape. When we come over here, we have some high prints here, which tell you that the market is alive and well. It kind of propelled, even though that was a blow off top. That sets momentum, and momentum tends to carry higher. But you'll notice here that we have like not a single print below zero this entire time, like right in there. Okay, no warning shots at all. Okay, because it's not only new highs, but it's also new lows, and the fact that there were no prints below zero tells you that, like, most, even if stocks are not making 3 month new highs, at least they're not making 3 month new lows. Okay, a little bit of a blow off top over here. Oops, somehow I got the wrong color. So a little bit of blow off top here. We got a high print here, but then we immediately drop down. Nothing. This is just kind of in the middle. We're getting some high prints, some low prints. It's all perfectly fine. Okay, nothing stands out. But if we do get a recovery here, we're going to want to see this get back up and consistently print up here. Okay, if you look down here to the 5-day moving average, here's the zero line. So we got a dip below zero, a little bit of a recovery, and then another dip below zero. If you compare that to over here, dips below zero don't happen very often with this indicator unless there's something going on. Okay, we got it over here. Okay, but we got a recovery pretty soon after. So if this moves down over here but can't recover, the market's going to be in trouble. All right, so mean, overall, I'd say the market feels fragile here. Breadth has deteriorated. If the market bounces, we'll need to see rapid improvement from these indicators. Otherwise, the market is going to roll over and fall again. And of course, the market doesn't have to bounce here. It could just sit here in a range. Maybe it corrects with time, or it could just fall. Okay, be flexible, be open-minded. This is not a time to take big risks. The path going forward is not obvious. All right, thanks for listening. Come check us out at Leavitt Brothers, where we offer market analysis and trading ideas to the financial community. Also, check out my free masterclass in trading at the link below. All right, see you next time.